Hello and welcome to Trading the Trend. My name is James Boyd. We got Rachel Dashel in the chat. Say hello, Rachel. And we'd like to welcome all of you. We got Bill here with us. Kelly, stay gold always like that. Um, Josh Pink, Sam, and many others. Welcome to all. The question we ask ourselves has already been asked in the chat by Will. And Will, well done today. Question is, you got to ask yourself, what trends are you riding? Maybe some investors, as they've been sitting in cash, yes, they might have a maybe some real return, but maybe that's not a big enough return to maybe hit your financial goals. Hence, we're talking about trading the trend. Now, let's go ahead and get started. Now, remember, you could follow, and let me show this just real quick. This class is being broadcast on YouTube. Someone in the chat made mention they're on their phone today. Well, welcome. Okay, that's a nice thing. You could be on an iPad, whatever. Don't have to be sitting on your computer. Maybe you're at an appointment, whatever. So welcome. Now, just real quick as we get started, I want to give us a quick reminder. You could go to X, formerly known as Twitter. Let me put this right in the chat. This is the page for Rachel for her X page as she posts educational examples throughout the day and announcements. This is my page right here. And what you're going to see is those two pages you want to make sure you're aware of because we try to post some great information. And there has been some great information. Probably some of the best information I've seen in the last 5 years. I've posted in the last 2 weeks. So make sure you're aware of that. It's really market data that really kind of helps you understand markets in general. Now, just real quick, as we get started, when we talk about examples, our examples will be stocks and options or the combination thereof. I want to talk about a little bit more today is why does maybe someone consider an option over a stock position? Kind of dive down into that a little bit. Also remember the information here is provided for general informational purposes only. When we talk about examples, we will do those on the Paper Money software application for educational purposes only. When we talk about investing, investing involves risk. There's always risk, okay? Sometimes it seems like there's more risk, but there's always risk, okay? And also remember when we talk about investing, it involves risk, including loss of principal. We could give back unrealized gains. That's also not helpful, okay? And also remember that's a part of it. When also we talk about examples, we will bring up probability. That's theoretical in nature, not guaranteed. It's dynamic. When we also bring up, let's say, a futures chart, whether it's gas, crude oil, and so on, we're not trading futures. That's Tuesday morning. But we're just looking at the prices and how it affects the index, the sector, and so on, or the industry group. Also, lastly, we'll talk about the markets first, then sectors, and then dive into some examples. Now, when we do that, let me pull up just real quick this chart. Let's start with the SPX. So when we actually broke out, let's see, what was it? The 16th? There was the 16th, okay? So on the 16th, a week ago, we got above the resistance, 69.97. Let's just say 7,000. Now, I don't think anyone's going to say it's been a barn burner to the upside, but I think the positive you would actually have to say is it hasn't really pulled back. Hasn't even tested the 7,000 yet. Now, when we look at the equal weighted S&P 500, what we've been talking about the last few days is could this be that flag? So far, not much of a pullback, which that's welcomed by many bullish investors. And if you kind of look at as far as what's leading the market, it is still yours truly, the NASDAQ. The group of the NASDAQ, which has been, well, bombs away to the upside, crashing higher, has really been semiconductors. Now, if someone asked me the question like, is this an uptrend? I would actually default to Rachel, and she could confirm that for you. Okay, whenever a stock is going 90 degrees vertical, or the sector in the industry group, etc., yeah, that would actually be an uptrend. Now, not every stock in that group is like that, but again, name me a space, sector, and industry group wise where we're seeing those type of moves. Pretty amazing. Now, I also want to bring up just real quick when we look at crude oil, which has been playing a factor. We still don't have a deal, okay, in Iran, okay? Kind of just floating to the land of nowhere. Crude oil holding 95. If you've tried to buy airline tickets as of late, you'll know that they're not cheap, okay? Salt Lake City to Phoenix, as I looked this morning to go for a vacation to Scottsdale over Thanksgiving, $615, okay? From Oklahoma City to Phoenix, typical routes we fly, $1,200. So those airline companies, they ain't flying for free. Okay, they want cash. Now, when you take a look at, let's say, crude oil, which we need oil to make the gasoline, when we look at the gasoline, what you are going to notice here today and why this matters. So first off, when we look at crude oil itself, could the energy sector be going back up after pulling back? What are some stocks in there that actually could be going up? Gasoline. We know that gas ain't cheap, okay? And if we take a look at this, what you're now going to notice is that hit a brand new high here today. What stocks, and I'm asking you, what stocks, what companies make gas? Now, we know that many companies like Exxon, Chevron, ConocoPhillips, they drill the oil and make the gas. They have the refiner and they sell it at the pump. We know that because we go to their gas stations. But the biggest actually thing is you got to ask yourself, are there some gasoline type stocks or products that are trying to track gasoline prices? Now, if we also take a look at, let's say, other names, volatility, okay? I think it's like what, 40% of the S&P 500 has earnings next week. So not completely unusual that some investors might question, how do I protect myself? How do I protect the position and so on? Many investors might have already been buying maybe groups of stocks in knowing that magnitude of earnings was coming up already. But if they bought individual stocks, they might say, look, is there a way that I could protect the downside just in case? That's something to kind of keep an eye on. When we also look at the 10-year rate, last thing here, kind of showing like a divergence-like setup here. Price or rate here, not making a lower low where the MACD is turning up. Now, historically, we said this, right? You get oil going up, you get rates going up, you get US dollar actually going up. You know, this can kind of put some flag-like or pullback behavior sometimes in the stock market. When I say stock market, SPX, NASDAQ, and so on, keep an eye on that. And also the last one I really want to bring up here is when we look at these, some of these names like utilities, decent bounce back here today. Now remember, these sectors, utilities, staples, real estate, healthcare, not as much real estate. They have more of an inverse effect to the stock market. If these are going up, that's usually because people are trying to be protective, okay? Low beta, dividend playing trades, starting to kind of see these get a little bit more of a move. Dollar sign IXRE, still in that pullback, but it's been a big move. Keep an eye on that. We don't really want to see utilities and staples going up because then that's leading us to think that are those investors saying the top is in the short term for discretionaries, technology, and financials. Remember, if tech is under pressure, discretionary is under pressure, communications and financials are under pressure, you're probably going to get a pullback in the stock market in the shorter term. That's just tends to be the reality. So keep an eye on those things. Now, if we take a look at this, if you're watching this brand new, okay, just know that some of these things we talk about, they're not new. Each time we do a class or every other time, we talk about these symbols all the time. Now, what I want to do just real quick is I'm going to fast fire through a sector. One of the sectors we said we're going to keep an eye on is industrials, kind of forming a double bottom pattern, okay? Can anyone name me a Dow stock that's in industrials that we kind of say, meow, okay? Caterpillar that got a little pump here this morning, brand new high. Now, also we said if we're talking about industrials, keep an eye on the Boeing. We mentioned that. We did a trade on that yesterday. Little brand new high on that as well. So just kind of keep an eye on those, okay? Now, what I want to do just real quick is some of you made mention, now on Caterpillar, let me go back to that just real quick. I mean, brand new high, earnings on that on 430, okay? A little crossover. The shorter term moving average went green on the 20th. A pretty decent move, about 7% or so from that closing spot right there, maybe 6%, okay? Pretty good move on that so far. Boeing we already actually have. I think the one we talked about, let's say the Dow, one of the other stocks we might keep an eye on is Travelers, which kind of looks like, and I'm not saying it's perfect, and rarely it is, but it kind of looks like you have this drop-down shoulder, drop-down head. If you're in the South, you call it a melon. And what you're now going to notice is a little right shoulder. Now, here's the deal. If we're looking at this, and this is one that is past the earnings, they already had it, okay? And now you're seeing that price push to the upside. So I want to kind of talk about some of these charts here, okay? So let's say someone said, James, stocks or options. Why does someone maybe consider using the combination? Super quick. If we have $50,000, okay, 50 grand, okay, and you say, look, each position I'm going to do 5,000. Well, if you did 5,000, you're going to have, in this case, 10 positions. How long would it take you to buy 10 positions? How long? The answer is not very long, okay? So what happens is if you buy those 10 positions at $5,000 a piece, you go through that $50,000 pretty quickly. If you're like most investors, you see other things that also look interesting, but you feel a little trapped by just only having 10 positions. You said, geez, there's other things that are going up alongside with the 10 I looked at. Are there other ways in which I could try to get exposure to that trend? Yes. Welcome to options. So the first thing is if the investor said, look, I got money to invest in stocks, trying to get capital invested. You don't want an expiration. You don't want a bid-ask spread. You don't want kind of also a situation where there's an expiration and so on. The investor is trying to get that money exposed to the market. Now remember, that does not have to be just stocks. Rachel teaches a class on ETFs on Monday afternoon. Kevin and I actually teach the class on Friday morning on ETFs. That 10 positions does not have to be just stocks, okay? Type in the chat. Are we all on the same page? Now, sometimes what happens is when that, now, by the way, if someone said, I have a mixture of stocks and or a group of stocks, that 10 positions, the investor might say, James, that only took me 2-3 days to do that. Maybe, okay? And then what happens is, man, there's other things that are going up and I just want to get exposure. Well, welcome to the options, okay? So the options kind of give us a way to try to diversify strategy. When we do stocks, we're really trying to do D for direction. And if they actually pay dividends, if you kind of think about this, you're really kind of getting paid from time of being invested, okay? The stock ownership, right? So D for direction, trying to get that direction right, and I from the dividend. Dividend not guaranteed. Now, those are two ways. When we talk about options, we might pick a direction, D. We might also still want T for time, but it's not dividends. It's time decay. And V for volatility. So we're just trying to add one more component right here. Now, when you look at, let's say, dividends, they're not on a daily basis. They might just be on a monthly, quarterly basis and so on. Can change. Now, when we talk about time decay, you know, that might be something more applicable over a day-over-day basis or a week-over-week basis. That is the only constant. Now, what we talk about here is also volatility, which affects the option price, okay? So let's make an assumption here that we've already done the 10 positions. Now, read my lips. Okay, Bria, okay? Bria, don't laugh here when I say that. Now, here's the deal. If you've already done those 10 positions, they could be a stock or a group of stocks and so on, whatever your heart prefers. If you've already done that, you might say, James, I have some extra capital that I might try to put some extra positions on, okay? Things like short put verticals, cash secured puts, okay? Long call verticals, especially the verticals, they don't take up a ton of capital. So if someone's doing stocks in a basket of stocks, verticals might be that next step because it doesn't take that much capital and it actually has a defined risk, okay? So this is not a ploy on doing certain things. This is just logic, just saying we ran out of money. Now, has anyone ever run out of money before in investing and said, man, I wish I had more money? I think most investors would. The other thing I want to point out here before we do our first example is some of your accounts are more flush with capital. Other accounts, you're trying to grow them. And so you might have to consider different strategies in different accounts because the dollar values are different. Okay? Now, could you just buy 1 or 2 shares of Apple or Amazon? Sure. But, I mean, is it really going to grow? I mean, it might take a while, right? So the investor might say, I might consider on lower dollar type accounts maybe a vertical type strategy where I could try to get exposure and maybe have a higher potential upside gain while defining the risk. Now, remember, you can do whatever you want. If you like stocks and a basket of stocks, have at it. It's your choice. If you said, James, I like that direction, time, and volatility, and I like that time a little bit more than dividends because dividends only monthly and quarterly, well, that's why we kind of use the combination. Okay? We're not saying we like options more than stocks. We're just saying we probably run out of capital and we're trying to diversify ways in which we can get exposure to the trend. Welcome to the world of investing. Okay? Now, if what I'm going to do in this case is if I went back here, if I said, hey, I'm going to go back to this, one thing we've kind of been focusing on is on doing buy stop limits, right? Now, if you don't mind, I'm going to kind of hit that, you know, on YouTube when you could say watch something at 1 or 1.25 and 1.5. Well, I'm going to kind of hit the 1.25, 1.5. Okay? Why? Because we can. If we take a look at this, if I come to TRV and I'm doing this on purpose, we're assuming that if I go look at the options that they're just going to be liquid options. Well, sometimes they're not liquid options. Our goal for our classes is bid-ask spread narrower than 20 cents. Okay? Well, what you're going to notice is it's not 20 cents, not even close. So if I come back to this and say, okay, on TRV, what I'm going to do is I'm going to right click on the chart. We've done this many times before. I'm not going to trade an option, even though I might initially consider that. Many of these stocks are higher price, eating capital more quickly. I'm going to go to buy custom, and I'm going to go with OCO bracket. Now, remember, we're saying if we're buying, buy the shares if we get to this price or higher. Well, if we get to this price or higher, now remember, if you kind of think, look, I want to see the stock push to the upside. And if you're saying, I don't like that upper shadow, 3 times we've actually hit that. We have not gotten above that. Well, what I'm going to do is I'm going to say, look, maybe 50 cents above that. I'm going to say 307.50. Okay. And then what I'm going to do is just kind of widen it out by $1, 308.50. Okay. Now I've never seen anyone back test. Okay. If we set a quarter on a $50 stock and we set a quarter on a $300 stock, it's kind of a little different, okay? I don't think we can say a quarter and just say, oh, that fits for a $50 stock and it fits for a $1,000 Costco stock. It's usually more about a percentage so it relates to the stock price, okay? And this example, I'm even only going 50 cents, okay? If we actually then push it to 308.50, we're saying, look, you got to get above 307.5, but no more than 308.50, okay? Now remember, we've done that before. So now here's the deal. The risk of this trade, if this stock gaps to the upside, does not fall below 308.50, it could miss the entry. If it fails, it's not guaranteed to go up. It could go down after we buy it, okay? Like any other given day. Now the stop underneath, what I'm going to do is I'm going to set the stop underneath that 298 level. That 298, as we do this here, 298.32, where the support level is, less 2%, 292.35. 292, okay, 35. Now remember, when we go back to position size, if we're saying, hey, we normally buy $4,000 worth of stock, fractionally, like how many shares is it going to be? About 13 shares. Our fractional shares, 12.96. Now, target-wise, if I said, where was that prior high? 311. Now, you got to remember is that's not going to be really enough to say we're going to target that. You're risking more than that by a bit. If the investor says, look, I think we could actually try to continue to the upside, prior high, where's the pullback to? Give me that 161 Fibonacci. Where is it? The earliest that we would consider trying to sell this, given a 161 extension, which we talked about last week, is right around 328. The 200% extension, 338. Okay? So those are kind of the markers. Dated GTC, dated GTC. Trade number 1. Now here's the deal. When I would teach live workshops, I would always ask people, how many of you do buy stop orders or buy stop limit orders? And on average, with a high sample size nearing 100 workshops, I found that only 15% at that point in time were using that. That is shocking to me, okay? So that means that investors are reacting. They're not using orders to try to get them in. Maybe reconsider if that's you. Now, what I'm going to do is if I go confirm and send, notice, remember how the stop works. We're saying if it goes to that price or less, sell the stock. Okay? Now, if we take a look at this, if I go back, okay, I want to go back to just something we're kind of just, let's take a quick look. When you look at the market, okay, something we kind of made mention of before is when we see oil, it's not oil up 20 cents. When oil goes up, okay, more aggressively, when let's say the rates shoot up, when the US dollar goes up, guys and gals, we just saw this a month ago, right? What do you mean? Well, we saw that when this is going up, that usually drags up the volatility, okay? And when those four variables go up, it puts pressure on the market. What does that have to do with the order type? Well, because that's why we did that. We said, hey, look, we want to kind of make sure in the market where we're kind of sitting right now, can the stock still push up in that backdrop? Okay. Now type in the chat that you have not forgotten about those four variables: crude oil, rates, US dollar, VIX. Type in the chat that you have not forgotten about that. If we forgot about that, please don't. Okay. Write it down on a sheet of paper. Now, let's kind of go back to something just real quick. If we were to say, okay, let's say we had a position and said, you know, James, I got a stock position and I want to kind of, for example, try to protect my stocks. Well, first off, if I looked in this portfolio and said, well, what type of stocks do we have? And I'm talking about stocks. Well, you got Amazon, 100 shares. And the second one we actually have here is CSX. Now, I'm going to use CSX as a lower priced example. Okay. Now, if we were to go to charts and just take a look at charts and say, what do we got on CSX? Now, by the way, transports. And when we look at the transports, what you're now going to notice is it went through the earnings. The stock pops to the upside. Okay. Now, if we just say, yeah, this was great, we're not really thinking it through completely. If this stock pops to the upside like this, we should be thinking about two words. Well, three words: moving average, envelopes. If this pops to the upside, we're thinking, has this stock maybe gone up a little much to maybe where it might be in the upper envelope? Now, when stocks get to the upper envelope, it's not saying that it can't go higher, but there's statistically, just kind of like Bollinger Bands, a greater chance of it pulling back. Now, option number one is, who cares? I'm just going to let it play out. That's, some people do that. Second, what some people might do is, James, I'm going to try to sell a call. We haven't checked to see what the calls are. Third is, James, I want to actually maybe collar the position thinking it might pull back a little bit. When it pops up like this, traders try to sometimes take profits. I'm going to go back and look at, let's say, the CSX for just a moment. Go to the trade tab. Now, we have the shares. What I'm going to do is I'm going to type in CSX. If you type in CSX, there's the position. Half, I repeat, half of the gain came from today's pop. Up 609, today's gain 304, half. Now, if I went down and said, okay, what are the calls and puts like? Volatility, because now earnings is over, it's at 26%. So here we are, a stock investor. And now we're saying, could we use options as a way to protect the stock? Now, here's what I've learned. Getting in and getting out sometimes can be risky, because if you do that over and over and over and over, you're taking a lot of risk. What some people do is they say, look, can I use the combination of selling calls and buying puts to try to brace the stock position? Now, you got to remember something. A, we still have exposure to the stock. Two, we still have an upcoming dividend probably right around the end of May. Someone might want to say, I'm going to try to stay in the stock and try to grab the dividend. Not a huge yield, though. Second, with that, they actually might say, is it possible to maybe sell a call with a delta of 30 to 40, which would be the 47.5, and maybe buy the put below with a delta of 30 to 40. Now, if we were looking at this, we might look at, let's say, the 47.5 and the 45.5. You got to remember something. Some people do not set stops. They buy the right to sell. Setting a stop, it's a trigger to sell. Doesn't lock in anything. It's a trigger to sell. It's an order. You buy the put, you have a contractual right to sell from now until expiration. You're not wanting to sell at 45.5, because if that is worth something, that means the stock has gone down. But that is the floor. Okay? Now, I'm going to go down to the Junes for just a moment. Just double check. We got the 47.5 and we got the 45s. Now, I'm still going to look at the 47.5s and the 45.5. Let's double check that open interest. And the problem with that is the open interest almost tricked us. Boy, if we were lazy, that would have been maybe potentially painful. 0 contracts. Now, this is 0 contracts coming in today. 46 today. So tomorrow it should be right around 46. But if we said, are the Junes more active or Mays? Not even a question. 159 with the, 296 on the open interest, activity 159, and you look at the 45s. So what we're doing is we're going to kind of brace the position. We're planning those short-term profit takers might come in and try to sell that stock down. Now, you got to remember something. Stocks, more capital intensive. And what you're now going to see in this case is they also have a higher directional sensitivity. Okay. Now, what I'm going to do in this position, I'm going to actually put this right here. And when we pull that position up, I just want to see CSX. And if we pull that up, I just want to put on the graph. So what is it that we're actually doing? Okay. The answer to that question is we're trying to de-risk. Well, how do you de-risk? Well, some people might say, look, I'm just going to sell. Okay. Well, wonder if we're trying to stay in a little longer. Wonder if we're trying to keep that portfolio invested. Well, okay. There's the diagonal line. If we had, let's say, 100 shares of stock, what you're now going to notice is there, uncheck that, 100 delta. That delta is showing you, it's showing us if the stock goes up $1, up 100, down $1, down 100. That's what that diagonal line is showing. Now, a lot of times, and I'll be the first one to admit this, stock pops up, I'm thinking, yeah, I'll tell you what, I knew I was going to be right. How many of you have ever said that before? But then you forget about those envelopes, okay? Well, we're going to go back to the trade tab. We're going to sell the 47.5. Now, how do you put on a collar if you already have the shares? Oh, simple. Right-click on the call that you want to sell. The call, selling the call, the obligation to deliver the shares at the strike price from now until expiration. So if someone wants the shares from us in the paper money account, they got to give us from 46.5 up to 47.5. Give us some money, okay? We're going to sell, and we're going to go right to where it says collar synthetic. How many of you think that that's not that bad? Right-click on the call you want to sell. Sell, collar, okay? Now, how do we know which ones to pick? Well, first off, we looked at the bid-ask spread. Second thing we looked at was the open interest. And third is, from those two questions, what's the bid-ask spread? What's the open interest? We said we're not going to be looking at Mays. We're going to the Junes, okay? Now, how do we know what strike to pick? We looked at the example of delta 30 to 40. If we look at the 45, okay, there it is. Now, if we take a quick peek at this, there it is right there. And by the way, yeah, so I'm just going to go back to this. We're in the paper money, going to go back to what delta are we? That 45.5, okay, is 39, okay? Now, how much does it cost? Well, it's, you're actually getting 5 cents. It's a negative debit there, okay? So let's just kind of look at the middle price. On the call side, okay, let's just double check this. If we got something like, we sold the 47.5, we're going to get $1.20 there. And on the put side, okay, I'm just checking these numbers myself, it's about $1.25. So collect $1.25, and I just double checking, probably getting paying $1.25. So we're actually confirming here, we're paying 5 cents approximately. It's taking the mark values, okay? So it's probably like neutral to maybe 5 cents paying, or maybe a credit of 5 cents. It just depends on where the fill is, okay? Okay. Now, what I'm going to do in this case, go confirm and send, and now I'm going to send the order. So what's nice about this now, if it starts to go down, we have a contractual right to sell those shares at the strike price. We don't plan to do anything with a put until the expiration week. The only side of the position that we would really adjust or roll is the short call. If the stock goes down, we tend to have one roll opportunity to sell another call in the same expiration month. But if that stock starts going down, we're using that 45 as a way to lock in the downside loss, okay? So make it easy on yourself. If we get in a caller position, starts to go down, we're not touching that 45 until the expiration, the week of it. Second, the stock actually starts going down, the call should shrink in value, should be able potentially to buy that back for cheaper. Probably got one roll opportunity. Why do you say one roll opportunity? Well, because if you roll it the third time, there's a really good chance that if you roll it again, you're really locking yourself in to sell the stock lower than what you probably bought it for. Okay, that's number one. And number two is the put. If the stock actually goes down, that long put is probably going to be having a higher negative delta, and it might be protecting all the delta or close to it on the shares of stock. Okay, now we'll see how this play out to kind of watch that. Now, the other thing is, question was, what's the relationship between S&P 500 and oil? Well, I mean, let's answer our own question. Okay, so let me bring up the SPX real quick. SPX. Now, and by the way, we could look at this in two different ways. If I bring up, let's say, Ford/CL, okay, which is we're going to use as a proxy for oil, okay? And if I actually brought this up, actually, no, we'll stay on that paper money account. Okay, there it is. Now, what you're now going to notice is, here's the crude oil price, okay? So there's the crude oil price. And what you're now going to notice is, I'm just going to kind of look and see which way is the easiest to read, okay? So if I brought this up, and I'm just going to bring this right here, SPX, and then I'm going to put that line. I'm just going to see which way it looks a little easier to read, okay? So, all right, I think this combination is easier. Obviously, if the SPX goes up, we get that, okay? Now, what we went through just recently was when we saw oil prices going up aggressively to over 120, okay? We saw the stock market go down over time. And what you're now going to notice is the correlation line, crude oil, as one went down, right? We saw really crude oil start to actually turn up a little bit, okay? And actually this chart, I think it's going to be better if we actually put it in a numerical correlation. But what you're noticing is here is sometimes you can actually see the SPX go up and crude oil go up. And that's my point, is that it's not always going to be that, oh, oil is going up, so the market must go down. That's not true. It's when oil spikes, when the US dollar spikes, okay? But definitely what you saw is when the S&P actually started going down, that correlation broke down. Instead of going up, you started seeing that actually going down, okay? So it's always remember, it's not just that oil is up $1, so the S&P must crash. It's when you get spiking, okay? It's not when the VIX is up 3 cents. It's when it's up 30%, 50%, spiking, key word, okay? Now, you could also flip that and kind of see what that looks like as well. Now, when we also take a look at this, let me show one other way we could maybe look at that. if I pull this up, let's hold the SPX for just a second. And maybe let's also kind of bring this up IXC. IXC being the energy sector. There it is. Applying okay. Okay. Now, here's the thing. Sam actually says, I'm slightly bullish on CSX. You just said it. Slightly bullish. Well, if you're slightly bullish, would you want 100 delta if you were just slightly bullish? That's the whole point. When you're slightly bullish, you're trying to change that delta profile. Okay. So when we actually go back to this, if that position got filled, remember, if you buy shares of stock, shares, okay, type in CSX, we know that if you buy shares of stock, well, it's going to be 100 delta by itself. If you put the collar on, the delta now goes to 21. So Sam, I'm going to press you on this a little bit, okay? When you say language like slightly bullish, does that mean you want to have the highest delta you can have? Now, maybe it is. But for many investors, if they said, I want to be moderately bullish, they might want to have a delta of 50 to 60. If they want to be slightly bullish, those two words, slightly bullish, usually people are saying, I might want to have maybe a delta from 10 to 30, okay? When you put on the collar, you are literally doing that. You're going down to that delta range of 10 to 30. How is it doing that? Because when you sell the call and you buy the put, it's pushing down the delta. The shares of stock, positive delta. Selling the call, buying the put, negative delta. And it's pushing that number down. Now, let's go back to oil, okay? Now, when we go back and look at, let's say, crude oil itself, is it ripping? Now, remember, just right in line, remember, the higher up this goes, the more that we would probably expect that the equity markets might get pressed down. Now, speaking of that, if we actually said, is there, let's say, an oil stock that might have some exposure to crude oil prices? Well, if we brought up a stock example given like Baker Hughes. Now, by the way, we can kind of go back to this and said, okay, we got Baker Hughes on top, and I'm just going to kind of put the correlation to crude oil. Now, sometimes the correlation is not constant. It's changing over time. Now, sometimes what you'll notice is when Baker went up, oil prices was actually going up with it. And I would say it like this. The crude oil is the red line. The performance, probably say it like this. The performance of Baker was stronger than the benchmark. Probably a better way to say it, okay? So now lately, what you've been actually noticing is Baker Hughes it's been not as performing as strongly, another way to say it. And now what you've been seeing is the oil price, which is the red line, benchmark. You're now starting to see that Baker Hughes is almost going in line with crude oil. Now, if we start to see that, let's say that green line starts going up, 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 and away from the benchmark, now you're kind of seeing why investors like sometimes stocks. Because they're thinking maybe it has a relationship to it, okay? Now, if you ask me, what do I like kind of a numerical number or a chart? I like a numerical number, the correlation number, the grid. When you look at this, we're looking at the performance of the stock or whatever we're looking at on top compared to the benchmark. So it does show some correlation, yes, okay? But now in this example, what I'm going to look at is you got earnings tomorrow. Now I'm going to bring up one other stock that's in that space, FANG. Now I'm going to choose the example of FANG because we're not on the doorstep. We're not on the doorstep of earnings like on Baker. So that's why I'm kind of switching here, okay? Now, these are not new stocks. If we kind of said, what do you notice on FANG? FANG was outperforming actually crude oil. You actually saw oil actually outperforming. FANG is actually still underperforming crude oil. Crude oil is the benchmark. Do some people try to buy the oil itself? We hit that, okay? Every Monday afternoon and Friday, okay? But we're talking about stocks here. Now, if we said, hey, James, I want to try to buy the shares, okay? And let's say the investor said something like, well, I I want to try to buy the shares and maybe try to do dollar cost averaging. Number one is I'm going to right click on the chart, buy custom with OCL bracket. Now remember is if you feel like, this is a little high, I might be thinking about it. I want to try to get in on a slight pullback. Well, the investor has the option. Don't put on the whole position at one time. Okay. What I'm going to do here is we're going to add this position, 197.5. We're not going to take a full position. Let's say we only do, $2,500. Okay. And if we actually say how many shares is that? 12. Now we'll set an alert that if it goes to this price or lower, we're going to try to add to the position. Now, if we go back and look at this example, this prior high was there, or body, down to the bodies of the candles. The 161 extension is right around 221. So I'm going to put that as a target. We've hit that a lot on looking at Fibonacci's. Now, when we take a look at this as far as the stop underneath, what has been acting like maybe some support levels? Well, the most recent support level might be in the vicinity of that 10-period moving average. Where is it? 190 flat. 190, okay? 190, there it is. 190 less 2%, 186.20. Now here's what we got to think about the next step. If I said 186.20, sell it if we go to that price or less. This is only for a half of a position. Okay? Now, we got to ask ourselves the question. If someone was trying to add to the position on a pullback, where might the investor try to add? Well, the investor might say, James, if we got a pullback right around to maybe that 190, 193, the investor might say, I'm going to try to add as we're closer to support. Two options: buy limit order. Two, set an alert. Right click on the chart, go to create an alert. An alert is not an entry to get in. It's an alert. Create an alert. Now if we go to this price, the keyword is at or below. I think we probably don't use alerts enough, okay? There's no cost for an alert. You can move them as many times as you want. If they go off, it's not like going to charge you. At or below. It's not in order to get in. But if we go to that price or less, let me know. Okay? If it does, investor might say, I'm going to try to get in. Now, so trade here was number one, we're trying to enter the position. Number two, if we get a pullback, okay, we're trying to add to the position closer to the moving average. Okay? Now, why did I not, just closing here, why did I not choose a collar? The spreads were wide, okay? They were 70 to 80 cents wide. Well, you didn't verbally say that. Well, I saw that, okay? And you could see that. So if we don't have the spreads we're looking for, we're going to alter back to the stock example. If you said if it was tighter, that's an option. The thing is, with a collar, we need 100 shares. Okay? Now, if I go confirm and send, there it is. Now, keep an eye on this, right? Crude oil, US dollar, rates, and VIX. If we start to see those push up again, these tools we talk about as far as stop adjustment, collars, and so on, investors are probably going to want to be aware of how do you actually try to protect profits and or capital. That does not mean a bear market. Sometimes you can get some flags or some shorter term volatility happening like we saw a little bit throughout the session. Not backbreaking, but down 300 and oil up 4. Now, remember that coming up next, we actually have Brett Crowther teaching short verticals. Join him. Thanks to Rachel for answering those questions in chat. Remember that with what we talked about, all examples involve risk. Understanding the strategies help you identify maybe what strategy that you might be okay with taking that risk. Okay, they're not all the same. And sometimes you like different strategies at different moments in time. So with that said, this has been the class on trading the trend, using stocks, collars, dollar cost averaging, all the above. And with that said, thanks so much. And stay tuned for Brett Crowther coming up next. And don't forget to subscribe. Take care. Bye-bye.